Hello and welcome back to the Ace of Trades YouTube channel. My name is Tanner. Thanks for coming out for another video. I just wanted to say thanks for all of your continued positive feedback. If you guys are enjoying the content, please like and subscribe. I am still working on that Discord. I'm putting a lot of time into it. I want to make sure it looks good. It's nice and clean when I have that link out for you guys. And I also want to make sure I have some educational references on that as well. Like this video today, the Greeks. I'm going to be adding a bunch of stuff about that into the Discord. Just in case there's a few traders who aren't really comfortable in that section of options trading yet, or they're new to it. It's just going to be good to have that there for people to learn and for people to consult. So anyways, today we are going over the Greeks in options trading. Well, first of all, what are the Greeks? Well, the Greeks are pretty much a way of calculating and determining the risk, the dimensions of risk and range that your options premiums have. So you're evaluating the risk and the range that you a trader can expect a premiums price to move, and you can use all of these different values in delta, gamma, theta, vega, and rho to determine how the premium price is going to move. And this right here is my last Palantir call that I'm holding on to. If you didn't see my last video, I went over how I thought Palantir was going to be moving at earnings date, which didn't go as green as I expected it to. But I did pick up some debit spreads down here pretty much at the end of Tuesday, right after earnings, because I was expecting it to be green the following morning, which it was. It was up 6%. I sold for good profits there. But I'm still holding on to this one call left, and I was expecting it to, go a little bit more in my favor, and I didn't have a chance to sell it early, so now I'm kind of holding on to it. But I like the way the volatility and the Greeks look, so I'm going to keep holding on to it, even though my expiration date is coming up very soon. Regardless, if we get into the Greeks, which we'll go over delta first, delta is a way of measuring how the share price affects the price of the premium. So if the share price goes up $1, exactly $1, and you have a delta of 0.18, now remember, everything's multiplied times 100 here, even the premium costs. I have everything written out in the decimal form, but just imagine everything multiplied times 100 using it in your own circumstances. So if you have a delta of 0.18 and there's a $1 increase on the underlying asset, it will lead to an $18 increase in the cost of the option. Pretty sweet. You can have delta ranges from negative 100 to 0 and 0 to 100 for calls, or 1.00. So that's pretty standard. That is pretty much the most basic Greek to use when trying to understand the prices of options. If we move on to gamma, gamma is a way to measure the changes in delta over time. So delta, you're measuring the changes in premium price based off of the security price. With gamma, you're actually measuring that rate of change that's happening to delta. So as you can see, I wrote out, since delta values are constantly changing with the underlying asset's price, gamma is used to measure the rate of change and provide traders with an idea of what to expect in the future. So if you have a delta of 0.18, again, carrying on from the last example, I tried to do that to make it a little easier. So if they have a delta of 0.18 and a gamma of 0.065, a $1 increase in the price of the underlying asset will lead to a 0.065 increase in delta. So if you multiply that times 100, that's about a $6.50 increase to the premium price when there's a $1 increase in the asset. So say you have ABC and your equity of your premium is sitting at $50. When the share price moves up $1, that premium price is going to go from 50 to 68, roughly. It's not always going to work out to be completely dead on accurate, but roughly it's going to go up to $68. And then at $68, the sitting delta is now going to be about 0.245 because we added the gamma, that rate of change, back onto the delta. So now at $68, if the share price were to go up another dollar, it's going to be moving up about $24.50 now instead of 18, if that makes sense to you guys. So just tracking the rate of change, that's going to be happening to delta. And if we look at this for delta and gamma, if we go back to my own options call that I bought, we can see that my delta here is 0.1587, which means that if Palantir goes up a whole dollar, which I'm going to need it to go up a few dollars to recover the cost of this premium, but if Palantir goes up $1, this is going to go from roughly $47 to about 63, which is good. I really need that to happen, like I said. And then we can see that my gamma is 0.0388. So that means that when it does go up $1, my delta then is going to be around 0.2. So $20 for every $1 increase. So, you know, using that, I could pretty accurately calculate how much I would need Palantir to go up in the terms of delta and gamma and share price for me to be profitable in this option again. Now, obviously, that's going to be changing again the next day that market opens. But, you know, once you have these options, it's good to come down here and be able to track how that price is going to move based off of a lot of different factors. So moving on, we have Theta. So Theta measures time decay. So suppose that you have a call option for a delta of 0.18 and a gamma of 0.065. If the call option has a theta of negative 0.112, now this is going to be negative because you are tracking time decay, and time is always going to have the same value to it. It's always going to be negative moving up to the expiration date. So the price will lose 0.112 or $11.20 of value the following day, no matter what. That is, even if the share price jumps $5 and those premiums are going to go up a lot because of delta and gamma, but they're also going to get differenced by the amount that's in your theta. So your theta is always going to be a negative thing for the buyer and a positive thing for the seller. Theta never is your friend when you're the buyer and you're waiting for the price of a premium to go up. If you are holding on to a security and you have an expiration date, theta is always going to be your enemy. You're always going to be fighting it. You're always going to be avoiding having large amounts of time decay. And obviously, when you're looking to do long-term options trading, your theta is going to be incredibly low. So you got to think about this as it's going to be exponentially increasing as it gets close to that expiration date. So I remember I was having people in the comments saying that they usually try to sell about a week out or around a week out with their options trades, and that's exactly why. This is why right here. Theta eats up the profits that you make in your last week. That's when it gets really, really exponentially growing. So it's really only good to be in a premium, a call option for that long if the volatility is super high and it still has a chance to move into a profitable range for you, depending on what the rest of the Greeks look like. So for me here, my theta is only negative 0.0838. So I'm losing only about $8.30 the next trading day on my $47 contract equity, which really is surprising considering this expiration date is only 8 days out. So it's because that implied volatility is so high, and the rest of my Greeks are kind of supporting for there to be large price movements. So people are looks like it's still expecting Palantir to be extremely volatile and having a lot of volume, which is a good thing because I want it to be able to move, a lot in a small period of time. As you can see, it does move quite a lot over the course of a day. And lastly, because I don't actually personally really use Row a whole lot, but I will mention it, we have Vega, which is the last, depending on who you ask, the main four. The main four is Delta, Gamma, Theta, and Vega. People don't really use Row too much. That's used to measure how the interest is going to be changing with the share price. So not as big of a deal as these other ones. But regardless, so Vega is the measurement of an option's price sensitivity to the volatility of the underlying asset. So Vega is pretty much calculating the amount an options contract price will increase or decrease based off of a 1% change in the applied volatility. So pretty much if you have, in this example I used down here, if the applied volatility is 50% and goes up to 51%, and the Vega is 0.22, investors can expect a $22 increase in the premium cost at that strike price, because each strike price is going to have a different implied volatility. You have to remember that as well. So my implied volatility is almost 147% here for this Palantir call. So if this goes up to 148% or 147.54, I can expect my premium to move up about $1.03. So times 100, that's only $1.03. My Vega is pretty small with this guy, but regardless, it's there, and depending on what security you're trading, what the volatility, what the volume looks like, all of these numbers are going to be different, whether you're in the money, whether you're out of the money, whether you're a year out or 2 weeks out. The Greeks are a really great way to understand the different dimensions of your ranges and your risks and your rewards. And it's just really important for newer options traders to understand that it's not something that they're necessarily going to be using constantly while they're options trading, but it is going to be something that impacts their day-to-day. If you are planning on holding on to long or short options positions for even more than a couple weeks, this is going to be something that's important to you, something that you can use to your advantage to know, even if the price of the premium isn't moving too negative for you, your stop loss is, I can take a little bit more of a loss, I think it's going to go back up. No, you can use the Greeks to decide, even better if that's a good decision or not. And that's something that I think is really important. And also, I wanted to note that Robinhood sucks in the category of being able to see volatility in Greeks and open interest before you actually buy the call or the put, before you buy the options contract. You are not able to see, as far as I know, you're not able to see like any of these stats other than the bid and ask price. You don't get to see the range. You don't get to see the Greeks. So even though Robinhood makes it really easy for people to do options trading and for people to do spreads, they make it really difficult for you to, use a lot of these tools to your favor beforehand. So that's another reason why I like Webull. And if you guys use any other type of, Market View, Market Watch, or any of these websites or softwares that have indicators and options prices, you'll probably have a better chance of finding the Greeks and all of this information before you go and you buy an options contract. So that's something important to note as well. So I hope I wasn't too confusing. This is another one of those things that's pretty easy yet not simple, both in the way of understanding it, using it, and explaining it. I tried to do my best. I still have a cold. I'm still stuffy, and it's not the easiest thing to explain all of this stuff, but I hope I did it a justice and you guys get a little bit of good information out of this. So if you like the content, please leave me some feedback, like and subscribe, and I will see you guys the next time, and thanks for coming out with me again today. Goodbye.